Right, good morning. Hi, my name's Steve Kelly. I'm the Managing Director of Thomson Reuters Extel, and together with Bernhard Wolf, who's Global Head of Communications for GfK, we want to talk to you about possibly a bit of a controversial subject in a way, the end of stock picking. Obviously for everyone doing IR, and indeed for everyone involved in active equity management and investment, one would hope it isn't the end of stock picking. And of course we don't really think it is, but there are some particular challenges around it that are present at the moment, and that's really what we want to talk with you about. The presentation, it really breaks into four parts. Firstly, I'll talk about some of the, trying to quantify, if you like, some of these issues around why stock picking, active stock picking is really facing a challenge and what that means in terms of investor relations. And as I say, trying to quantify that with some various aspects from a wide range of Thomson Reuters data. And all of that, while it's sort of real data, of course, is in a sense theoretical. So then pass on to Bernhard, who will give you a very much a sort of, from the coalface, a practitioner's view in terms of what's happening, what he's seeing in terms of investor relations, in terms of interaction with the sell side and particularly with the buy side. And those will be the two key parts of the presentation. And then very briefly after Bernhard's spoken, the main Extel results for 2012 actually don't come out until next week, but I have a couple of pages on some of the key trends from Extel 2012, so that's very fresh data, which we just thought we'd share with you. And then the fourth part, of course, is to take any questions that people may have. But clearly, you know, if there's anything that is unclear, just say so at any point during the presentation. So, going to the first slide. Okay, the left-hand side, let me just wander around. I'll take this with me to remember this. Yep. Otherwise it'll be a bit difficult. The left-hand side sort of sets out here some of the issues that all together add up, not quite to the end of stock picking, but I think certainly the end of easy pickings as far as investor relations is concerned in terms of approaching and competing for investment dollars. There's a lot going on. All, I think, in a sense, coming from that top point about the macro perspective that the market currently takes, the risk aversion that there is in the market, and that, along with some of the other issues like correlation, like fragmentation, etc., is all adding up to making a much more challenge for equity investors to identify value themselves, and for companies to project and communicate their company story properly to the market such that it is genuinely understood. But there are some opportunities as well. Active stock pickers haven't died entirely, although you know, in the UK, and to a certain extent, I think they're a pretty diminishing breed. But there is, in certain areas such as sustainability, there is more interest. There's obviously a significant amount of interest, I think, from all major European companies in what they can get out of Asian investors, and we do see increasing interest from Asian investors in Europe to an extent, but I don't think that should be overplayed. And I think underlying all of this, because of this challenge in the market, and because, as I say, some of the data that we'll go through, which I think just sort of quantifies that challenge, the need to communicate the corporate story and actually do so in an intelligent, transparent way, which builds trust with the market, creates an environment in which investors believe in the stock, obviously all comes back to doing intelligent, good IR on a long-term, consistent basis. And so, yeah, whereas some years ago, arguably, when the markets are sort of going up 10, 12% each year, as long as you had a halfway decent story and you were vaguely professional in terms of your investor relations, you would sort of gain from that situation in which a rising tide would float every boat, into a situation now where the market is far more discerning about an individual equity story, and indeed, as I say, in many cases is struggling to even see that story against the overall macro environment. So good IR is all the more important, and it needs to be more strategic as well in terms of really getting through and communicating to the market. So the macro factors, just I think this has been the case really now for about the last year or so in the market, that beta is much more important to investors than alpha. And you can see that in a number of ways. I think, you know, the fourth point down there, second half 2011, 6 times when virtually every single constituent of the S&P 500 moved in the same direction, and there are only 11 occasions of that in history. That is a really strong indication of the way that the correlation is coming together and the way that the market is effectively looking at overall factors and ignoring individual corporate stories, which of course for people doing investor relations can be very frustrating, that you've got a very strong story, you're trying to communicate it very well, your CEO and CFO are out there on roadshows and doing one-on-ones, and it has no effect at all. How come? Well, the reason is because the market isn't really wanting to listen to those stories in many cases because of the dominance of the macro factors, obviously here in Europe around things like the Eurozone crisis, etc. But just generally in terms of, it's interesting. Going back to 2008 when the market crash sort of happened, or the big global financial crisis, I think there was a period in the market then when clearly end of 2008, early 2009, virtually all the market practitioners were sort of spooked by what had happened then. And there was certainly, from when I was speaking to the buy side around that time, their main aim was to be there in 2-3 months' time. That obviously passed as a period because you can't live forever in a sort of permanent crisis. And to begin with, that was replaced by a view that things would get back to normal and the market would recover and valuations would start to increase and there would be a more sort of normal level of activity. And that really hasn't happened. And as a result, what we've seen in terms of how the investment community, and here particularly I'm talking about the buy side, but also I think the brokerage community as well, is they've started to come to realize that effectively the world we're now in of lower volumes, we'll have a little bit more on that in a minute, this sort of high level of macro focus, the low level of returns that one can expect from traditional or established equity markets is, if you like, the new normal. And that's the world in which they have to operate. And as such, that has created or has just emphasized this sort of lack of risk that the market wishes to take. And particularly at the moment, given in Europe, you'd be a pretty brave or foolhardy equity investor to be investing in Greek stocks, for instance, Spanish stocks, until the market is somewhat resolved. And so that is having a much wider effect, both in Europe and internationally, in terms of how investors are looking at the market. So one way that that's demonstrated, 1 month in the last year and a bit, when there's been inflow into active equity funds, and that was a year ago. So every single month since then, as this Thomson Reuters data shows, there's been outflow. Some month obviously pretty extreme, like last November. There'll be a number of specific factors around that aren't really important, but the trend is very clear. And that trend means that, of course, essentially there is less money out there for companies to compete for, but there are essentially not less companies. And if anything, in terms of the overall improvement of the way that companies want to communicate with the market, the increased activity in terms of number of one-on-ones, roadshows, broker conferences, there are essentially more mouths which are trying to be fed with less money. And that means that if you're going to get your slice of the pie, you have to be communicating even better, even stronger in investor relations than you have before. And another factor which is making it very difficult is the increased fragmentation of where that stock is traded. The old days, and certainly as you can tell I'm old enough to remember them, when a stock was essentially 100% traded on its domestic exchange, and you as an investor relations could have a very clear perspective on who was trading, what was happening to the stock. Those days have gone, and one can only believe that those days will continue to go further away in terms of even more fragmentation. There's a lot of motivation, and I know Bernhard will talk a little bit about MiFID, which sort of began all this in creating the environment in which fragmentation could take place. But all these players, Boat, Turquoise, etc., are not going to go away, and they're all competing fiercely, which is only going to add, one feels, to the level of fragmentation. And I think two other points I just pull out on here. That percentage of dark pools activity, this is all data collected from Thomson Reuters. And the dark pools, dark pools are not called dark pools for nothing. So you can't necessarily exactly find out what's going on there. My strong suspicion is that number up there is probably less than the real amount of dark pool activity. So that's one factor. And I think the other factor, particularly interesting for perhaps for the Frankfurt Stock Exchange, is when you look at, so essentially half the trading of DAX is not domestic and half is international. But when you look at the half which, half is through these other venues, but when you look at the half which is through sort of primary exchanges, some 20% of that is being traded through London. I think that's a very interesting statistic. I suspect if you reversed it, that really wouldn't be the case in terms of the amount of FTSE 100 stock that is traded out of Frankfurt. Okay. But having said it's fragmented, it's not as fragmented as you can see as it is in London. And it's the French, the CAC 40 exchange is pretty similar to what it is here in Germany. And I think that's a reflection of two things. Firstly, that London obviously historically has always been a very international financial centre, and so there has been more international trading, more international interest in London than in continental European exchanges. So that's certainly one factor. But I think what it also relates to, and another couple of my slides sort of pick up on that as well, is the inherent strength of the German economy and the fact that there are a lot of good companies in Germany with a very strong story, and those stories are very well communicated by some excellent IR, I think helps to protect Germany from some of that increased fragmentation and that increased breakout that you see elsewhere, and particularly in London, where, as a lot of the Excel data would demonstrate, the quality of IR in the UK is much more variable than the quality of IR in Germany. German IR, particularly in DAX 30, but I think MDAX, SDAX, it would be the case as well, is very strong, very consistent, very professional, taken seriously, taken increasingly strategically by the market. In the UK, there are pockets of excellence, where there are companies who are doing investor relations as good as any company in Germany, but there are also pockets of, how can I put it, areas where they could do a lot better, to be honest. Yeah. What we got now on the next couple of slides is some of the key firms who are investing in German equities, and some of those who are selling them. And I think there's another factor here. Obviously, quite a few of those names, Decker, Allianz, Union, etc., and Frankfurt Trust, are obviously German-based asset management firms. I think there is still, we see, as well as those firms obviously investing globally, they continue to believe in the German economy and in German stocks, and effectively in German equities as a story. That, again, I would say from a UK perspective is a real contrast with UK-based equity funds, long-only funds, and obviously there are more buy-side firms based in the UK than there are in Germany, but those buy-side firms tend to have a far more less positive view on the domestic market in the UK than the equivalent firms do in Germany. And I can't think the last time that a UK equity fund was actually launched. Those days largely have gone, whereas essentially for German buy-side firms, there is still a big belief in the strength and quality of the German economy. And again, to an extent, I think that is both reflected and endorsed by the quality of investor relations that happens here. Okay. So you can see here some of the key buyers internationally, also how that breaks out, where there's a fairly good distribution in terms of the geographic domicile of the buy-side firms investing in DAX. Okay. On the sellers, you can see it's much more dominated by the rest of Europe in terms of where those sellers are. And those are some of the firms there who are selling out. Some of the French, apart from anything else. Quite a few of those. I think an element of that, of course, is the particular issues that France faces vis-a-vis the Eurozone crisis and the level of exposure that France has to Italy, Spain and Greece, which in terms of the overall economy and certainly some of the investment firms there is absolutely massive. Okay, just a couple more things. But so active equity investors still very much exist, and again, we put those names up there because to give you a sense of exactly who they are. I think that could be interesting to you in terms of trying to identify who the right targets are. It's a fairly wide range. I think though within all of them, against this background of fragmentation of the real high correlation of the way that the market is macro driven, the need to communicate with them, to be consistent in the story, and to really understand what it is that investors are wanting, both and very much individually rather than just at a firm level, is critical, and that's the bit that certainly Bernhard is going to be talking about in just a second in terms of how you actually do it. But I just really would stress that. I think you know, a lot of these things, and we've put them up, and this thing won't go backwards, so I can't show you some of the earlier ones, but you know, where we were describing what types of funds are, whether they're GARP or growth or value. I think for large buy-side firms, those definitions are increasingly becoming sort of meaningless, because within the firm, different PMs will be operating in a slightly different style across in terms of their own funds. And the importance of the individual portfolio managers in terms of the money they're running, and therefore the autonomy they have within the firm and how they run them, I think has never been higher. There was a sort of period 4 or 5 years ago where the importance of portfolio managers was within a buy-side firm was essentially decreasing. I think we've really seen a revival of the role and the importance of the PM. And as such, that makes the role of investor relations much more challenging, because it's not a case of, okay, when we go to the US, we must go to Boston and see Fidelity. Yeah, of course, you know, everyone can sort of work that out. But it's exactly who you approach within that firm, what particular buttons you press with that individual, or those group of people, that will make a difference for your stock story, I think is really vital. Okay. And I'll now turn over to Bernhard, who will take some of this theory and actually give you some sort of hard practice, as it were.
Hard practice. Thank you, Steve.
Sure.
You put that level quite high
yeah.
for me.
Oh, but I'm sure you can climb that bar. Yeah.
So when we look at the investor side, I mean, what they expect from the markets, give me the shares. I wanna buy. Make that quick and make that very cheap for me. I think that strategic approach is very, very easy to understand. And if you look for the 4 bullet points I put down, competitive conditions, 40 hours, 7 days trading, anonymity, indications of interest, that typically are parts, I would say, of a stock exchange. If you take all of those elements, a stock exchange should fulfill those requirements which typically an investor has. And if we look and if we see now that alternative platforms get more and more attraction and get more and more market share out of that, something is going wrong. So the question is, why the stock exchange can't anymore be, I would say, as a natural partner of the investors, and therefore as well as a partner of ours in that game. If we look at the advantages on the investor side, which are clear because they get more flexibility, there are some disadvantages, and I see that mainly on the company side. First, it's not our task to comment in which way the investors buy the shares. I mean, for us, it's more that they get what they want, they get that around the clock, and then if the investors are happy, more or less we are happy as from the company side. But what we presently see is, first, it's the complexity which is coming up. We see dark pool pricing stays in the dark, so we lose clarity about what's going on into the market. The shareholder identification becomes more complex, and so on and so far. And besides of this, we do not pay for that. We pay for the stock exchange. And the stock exchange now is no more that part which represents the biggest proportion of the market. So the question is, do we pay the right person? Or do we pay the right authority? Or what's going on in that game? So the second takeaway for that is, what's going on with the stock exchange? What is the answer of the stock exchange that they are no more dominating that play? This is quite a condensed chart. You put, I think, 3 charts together in one. So,
well, one of my colleagues did, so if you don't like it, you know.
I love it because it gives you all the clarity. I'm a market researcher. I love data. So let's start from the left-hand side to the right-hand side, from top to down. What you see is the green charts, the green elements. That is not the green parties. That is alternative platforms. And what you easily see here is, starting this year, the share price of GfK shares performed quite well. There was a big jump until, I would say, early February, and then it was more, I would say, a sidestep. And then you look down what the trading volume has done, and you see wherever trading volume comes up, you know, the answer was not given by the stock exchange from the trading volume, but from the alternative platforms. And that is something which worries me, because, you know, I'm not seeing the real picture in the trading volume of the stock exchange. If you look at the right-hand side, then what you see over here is still more than 50% is on the traditional markets. So at the stock exchanges, you see Citra, you see the London Stock Exchange. I have to learn more about that. And you see Stuttgart, Stockholm a little bit, but mainly it is Citra. So first, I still have a little bit more than 50% of our trading volume in my focus. But then all the others, I would say, I'm in the gray zone. I have no clear understanding of that. And that is not only for GfK shares, it is for the DAX companies, it's for which company you want to look to, you will see a slightly similar development in that. So what is now GfK situation? I talk about a company which is a typical mid-size or small-sized company in that area. Again, let's start from left to right. What you see here first, top 10. It's a nice chart telling you that we have really an international shareholder basis. That's roughly 22%, 23% of our free float. We have 40% free float. Half of them you see over here within the top 10, and you see, I would say, really nice names in that chart. What you see as well is, and then now I shift to the very right-hand side, is they hardly come in and they never come out, to make that very drastic. Because for Fidelity, it needs for them 135 trading days to get out of GfK stock. I mean, from my perspective, I'm fine. It should be 5,000 days, you know, because I want to keep them forever, you know. But I mean, that is not the real answer to them. It makes a little bit some pressure on them to decide whether they want to jump into that chair, and because they know it takes a long time to get out. And to combine that with that, I have no view on the 50% of the trading volume. That makes a little bit stress on my business. And you see the others with 61 days for position number 2, 60 days for Mondrian. That is not really a good answer a company can play back to their investors. That it is a little bit complex to get out of the shares. So what is one of the takeaways from my day-to-day work? First, we really have to take every support in our day-to-day IR work which we can get. You know, first from the brokers, we need high qualitative feedback from the roadshow activities. That means not only, okay, fine that you came along, blah blah blah, and so on. Just put that here from Merrill Lynch, and we have some others as well. Details. What can you improve? What has come back to that presentation? What the investor keeps in mind? What he wants to see next time, and so on. So high qualitative on that, and very detailed, and very intensive market details. So push your broker that they tell you not only where to show and not only to see those investors where they are linked best, but also which you need to see now in your specific situation. You have shown a couple of investment firms which go in or go out of European markets. You have to know that. You have to know that. Otherwise, you can't play against that. If you see a fund manager which just decided to say bye-bye to European markets and you show up, okay, what can you offer? You know, even if you have an excellent company in your backhand. So the conclusion out of that is we have some structures which started five years ago, and the beneficiaries mainly are the institutional investors. Investors look at best price, highest speed, and I think that is very fair. And typically, this is the definition of a stock exchange: to bring both sides together in the most efficient way, and then match it, and then it's the result is trading volume. And so from this, I can't see why this should not work. Traditional stock exchange should ask why more and more their typical clients choose different and alternative ways. And what is real of equality for all investors? Think a little bit about the privates, which have not the alternative to go on alternative trading platforms. So they still benchmark their portfolio development against the Citra trading, what they see. And that represents, in many, many cases, less than 50% of the trading volume. So they do not really get the fair view onto the market. And transparency is not a one-way road. So we were forced by the stock exchange, by the Frankfurt Stock Exchange, to give clarity, transparency to every market, you know. But from the other hand, we don't get the feedback who are our owners. I think that is inadequate. We need to get easy access to who is owning our company. So it's a clear message that from the legislature, it is not really a good answer where we are presently. There should be some big new points, and those should really improve the situation of the companies. So what are the to-dos? Some might sound to you very familiar, and that's good because then you are really, I would say, up to date with your activities. Know your shareholders. And I think, and you have seen that in the chart, it pays off if you have a personal, I would say, discussion with your shareholders. Even for Fidelity with 135 days, they gave the answer. They jumped into GfK. And we have that continuous conversation, so it still pays off to do whatever you can do to talk to your investors. Analyze the trading flows on a monthly basis. Reduce volatility. That is something which is still an open problem for my company. It's still something like that, you know. And I know that afterwards, you know, then you're then you have the learnings. But you know, I should know that in advance. Designated sponsors can help. Detailed roadshows, it's an absolutely must, and you can choose your broker who's giving the best service to you. I mean, it's more than fair to ask if you offer your CEO, your CFO for roadshow activity, I want to learn what comes back from the market. And the direct contact, I would say, it's still key. So I'm not so skeptical that nobody will anymore listen to us. And all the electronic platforms will grab everything out of the market, but it's getting tougher and tougher, and that's more for you.
Okay. Okay. Thanks, Bernhard. I've just got a couple more things that I wanted to share with you, and this data is from Excel 2012. So that's the annual study which we conduct, where we get views from all three sides of the investment community, and some of the numbers and some of the sort of points here. Obviously are pretty new in that the data is not actually formally released until next week, so this is sort of hot off the press, as they say, and it's based in total on the views from some 6,000 buy-side professionals, so PMs, buy-side analysts in the main. There's also views from companies in this, and that's about 1,000 people from 800 quoted companies across Europe. And I'm not sure if we've got any views here in terms of what the sell side think. But if we have, then it's about 2,500 sell-side individuals. So it's a very comprehensive data set and very complete in terms of the view that it gives in the market. And just going through them one by one. I mean, the first one is sort of, yeah, it was always so, but clearly the role of CEO and CFO in terms of communicating the company story and effectively acting as the trigger for the investor, having done their research, having constructed their models, having looked in detail at other alternatives of various peers. So they've decided to buy the company. Are they now going to buy the man or the woman running it? And that's where the CEO and CFO meetings are really vital. But I think what's interesting and what we're seeing as a change this year are the points 2 and 3. So there's less value, definitely, in terms of site visits and investor days. That's what the buy side, this composite of 6,000 buy side people are saying to us, that they're getting less value out of those. I think we've seen that a little bit in the market in the last year or so anyway. Personally, I often think investor days are a badly named thing because they tend by and large to be analyst days rather than investor days. And it's much more the sell side that will be attendance investor days than the buy side anyway. But they are doing less of them. But they want more roadshows, And I think that's a reflection really of two things. For a long time, the data has told us, and all the discussions that we have with the buy side would emphasize that the buy side much prefer to see companies in the buy side's office. That's because it's easier for them, obviously. They don't have to travel. It also, I think, works well for companies, actually, because coming back to the point that it's not so much going to see Fidelity, it's who you're going to see at Fidelity. You definitely have more chance as a company in meeting more PMs, more analysts, certainly more PMs, at a buy-side firm if you actually go to them, as opposed to, obviously, when they come to you, they're not going to come as 6 PMs. It's only going to be 1 or 2 at the most. But I think the other factor about that is that in the market situation at the moment, it's not only companies struggling to get their corporate story out there, to get investment dollars to increase the value of their stock, and it's not only the brokerage community struggling in terms of trying to generate revenues from commissions in the market, let alone from primary business, but it's the buy side too. The buy side are not overall in a very good place compared to where they were 3 or 4 years ago, and so they have less money. And that, I think, is not an inconsiderable factor in why they much prefer companies to visit them rather than going to see companies themselves. So those things come together. Within that, one thing that investors are looking for more and more is access to divisional directors, to drill deeper into companies, to understand the value. Yes, there's always going to be an element of the buy-side community which is doing that because they believe that if they speak to some guy who's running, I don't know, the Latin American business or whatever it is, that he will be less experienced, less capable of dealing with investors than normal, and so he will say things that perhaps he really shouldn't, and they'll be able to extract an advantage out of that. Definitely happens, but I think the vast majority of the buy side are doing it really because they want to get deeper into the company, they want to understand where the value is, they want to speak to the man or woman who's responsible for 30% of the profit and 50% of the profit growth in the business, whatever it may be, to really understand where that value is. And in doing that, so they want divisional director access, and they want it in a more informal basis, coming back to the top point, they don't really want it through investor days, which is classically how companies and IR teams will tend to deliver divisional director access, because of course that is a challenge for IR teams, both in terms of logistically just managing it, coaching people, being there in meetings, you know, how many can you actually do, how many divisional directors can you support, but also because companies prefer to control the divisional director access because of the potential problems about people not going off script, not being so well rehearsed. But that's what investors want. And I think the real difference there, so you know, nearly 80% of investors say it's really, really important, 12% of companies are actually offering it. I think, you know, clearly there's a mismatch there, and I think in terms of enhancing the way that the market understands the corporate story in this overall sort of difficult macro climate that we outlined at the beginning, that to work out ways to give more access in a more ad hoc, informal basis, more direct one-on-ones with divisional directors, I think that's a key challenge for investor relations that can't really be ignored and say, oh, we only do it for investor days. You've actually got to work out a way that you can do it that reflects more what the buy side appetite actually is on this. The fifth point down remains very much true, but I think as companies are putting more effort into investor relations, as there are more and more opportunities for the buy side to meet with companies, and we'll come on to that on the second slide here, the requirement for investor relations people to be able to speak strategically about their stock and about the sector and about the industry is essential. Otherwise, you know, what's the sort of point of IR if all you can do is say, well, I've got to refer that back to the CEO or CFO to answer the question. Investors expect IR to be able to speak both about the numbers, both about the strategy and the vision of the company in a coherent way that the investors can actually effectively deal with IR, particularly after they've had an initial meeting with CEO or CFO, without the need to constantly revert back to CEO or CFO. I think that's a critical point. And the last point, I pulled it out because I thought it was a very interesting piece of data that, you know, everybody talks a lot about Asia. Is the market domestically in Asia in terms of investors based there investing in Europe? Is it that big? It's not nearly as big as the initial numbers would suggest, but it's still quite large. Certainly both US and European companies are increasingly attracted by the concept of getting Asian investors in the stock. We're seeing a lot through some of our Thomson Reuters data of people like China Safe, China Investment Corporation, taking positions in European stocks and starting to take that in a more traditional long-only way as opposed to just effectively a sort of index investment. But less than 2% of companies, so 800 companies, over 90% of Europe's market cap, that data is based on, have anything like a high level of engagement with Asian investors. And actually, if you were to take GIC out of that as an Asian investor, then the number would drop, that percentage would drop even more. By far, GIC is the #1 sovereign wealth fund operating in Asia that people have access and interaction to. And of course, they operate quite well out of London, although just on GIC, we're seeing more and more money, European money, being run out of Singapore from GIC, effectively being repatriated in terms of who's managing it and who's controlling it back to Singapore. So that's one side of it, which is mainly sort of the buy-side view. The other side, and pick up a little bit on what Bernhard was saying about roadshows and corporate access. So if you speak to anybody on the brokerage community at the moment, the lack of volumes in the market is the real killer for them. It's been bad in terms of what the volume level is. It just gets worse and worse. I was speaking to a couple of heads of research last week, and they said, this was in the middle of last week, and both of them independently said that last Monday, whatever that was, so just over a week, literally a week ago, that the level of volumes was incredibly low. That they, both of them, said that they sort of went round to their trading floor and just wondered if somebody pulled the plug out and they just couldn't do any trading because nothing was happening at all. And I think the volumes are at such a low level and continue to be very, very low that it's causing them a real problem in terms of how they actually generate money at all. And the reason for saying that is that's part of the reason why the brokers put more emphasis on corporate access, because that is a way that they can generate some revenues. It also has the attraction in terms of the brokerage community that it's a way that they can attribute revenues back to what they do themselves. There's always been this problem for brokers in terms of providing research and advisory services that they may, their utilities team may issue a very interesting piece on the future of the utilities industry in Europe, say post the Japanese nuclear disaster and how that's going to impact people like RWE and E.ON, etc. And yeah, the market would be very interested in it, but will end up paying for that research from Citi or Deutsche or whoever it was through some derivatives trade in Japan. And it becomes very difficult to attribute the value back to the intelligent sort of thematic piece about what's happening to the utilities industry in Europe. The thing about corporate access is it's much more directly attributable. So in this world where volumes are very low, if you can generate some revenues for corporate access, that's all well and good. And I suspect everybody involved in IR has seen that over the last year in terms of the number of brokers coming on to them to say, we'll organise a roadshow for you, we'll do this for you, you've got to come to our conference. The level of activity there from the brokers is hugely competitive at the moment in terms of trying to get companies on roadshows, going to conferences. And I think that's a big challenge for companies in terms of trying to work out which are the right ones to go with and how to do it. And it's interesting, so companies value the service, as it says there, about 2/3 of them, but they much more value what they do themselves. And I think that then picks up on some of these other points about local expertise being the #1 thing that companies are looking for when they select a broker for a roadshow, and the frustration that companies have about inappropriate PMs being at the roadshow meetings, or completely irrelevant ones being there, and also the desire, which of course the brokers have, to get the CEO and CFO to attend these meetings, because doesn't that look better? Aren't they therefore sort of proving that they're important and their value? But very often the feedback that we're getting from the companies across Europe is that that's all becoming a bit embarrassing because the CEO and CFO are being effectively obliged, and you're requesting them to turn up to meetings because the brokers have said, oh, you've got to have the CFO at this meeting, and it's not turning out to be worthwhile. And obviously, in terms of...
But is that not also because of the way that the funds then trade afterwards, that they do have something of a ranking? So if a broker puts a CFO, CEO in front of them, they get, I don't know, 100 trading points. If it's a head of IR, it's 50, some deputy IR, 25, and so on. And when they do the trading with whatever stock, you know, not related to the CEO or CFO they saw, then they will sort of use these trading points again. So at the end of the day, every broker wants to have as many days of the CFO or CEO of any company because they just get more trading volume on any stock whatsoever. So basically, you are just a puppet going there, and they, at the end of the day, maybe the investor can't be bothered as long as the broker gets his trading points.
Yeah, to an extent. I mean, there's definitely that correlation, but I think what this data is saying to us is that when those some of those meetings are taking place, that the for the investor, the value of the CEO or CFO being there is really not there, that they didn't need them to be there, but the company has sort of been obliged to bring them along because the broker said you've got to do it. And a lot of that, I think, is sort of driven by the ego of the brokers. That may surprise you that the sell side has a high ego, but we think it does. Because they want to be seen as being more important, that they've arranged a meeting that your CEO was got to attend. And I think, given that virtually every IR director, IR team in the UK and Europe reports into CEO or CFO, and essentially I think it matters little whether it is CEO or CFO, then clearly in terms of your own sort of career progression, to arrange a set of meetings which take a big chunk out of the CEO or CFO's time, which then turn out to be meetings that are irrelevant and not worthwhile, is obviously not a very good thing as far as the IR team, the IR director themselves are concerned. And I think that's becoming the critical point, because I think an older issue around logistics, which some years ago we saw as quite a frustration amongst companies, that the car wouldn't be there. You get to the meeting and it was actually going to be this afternoon as opposed to this morning. Nobody was too sure where the next meeting actually was. Was it that side of Manhattan? Was it this side? That sort of logistic thing has largely gone away. And the brokers, because they put much more resource into corporate access, because they've become much more focused on it, are tending to get all the logistics right. And more or less any broker worth their salt will do a decent job in terms of all of those organizational things, but it is much more now about that local expertise that they have and the ability to actually put the company together with intelligent investors who are interested in the stock, as opposed to just who their top 10 investors are. And one final point on that, which isn't actually on this slide, we construct a lot of data looking at US one-on-ones. In terms of the brokers organizing one-on-ones in the US, some 50% of the meetings they have are that they organize with hedge funds, but who as themselves are only then responsible for some 6% of the investment decisions. And there's a real mismatch that the brokers are putting companies in front of hedge funds as opposed to long-onlys, just because those hedge funds are so critical for the commissions that the brokers are getting, but are not really going to be useful investors in many cases as far as the companies are concerned. And then I just pulled that out as a completely sort of random piece of data, as it were, about apps and social media, just because it's sort of such a hot topic in a way. But I think big differential there. So everybody says, oh yeah, they're really going to be important. We've really got to do something about it. Must include it in the IR program. Must have our own Twitter feed and all the rest of it. But they ain't got a clue what to do. Only 6% have any idea really what to do about it. It begs a different question, which I'm sure everyone would have a view on, as to whether or not such things are important in IR anyway, whether in 140 characters you can really communicate a completely different message, whether you'd want to, whether you're allowed to. But I think there's a big sense here of everybody thinks social media should be important, but in reality nobody's really doing very much about it. And possibly the way that the Facebook IPO has gone is a suggestion of, the hype is more interesting than the reality on it. And that sort of concludes our presentation. So the next one should say questions. So any questions anyone's got, I'm more than happy to take them. And thank you for your time.
Speaking of the last topic you touched upon about the social media, do we have any information from Excel or anywhere how are the investors taking that? Is anybody saying, all right, I have GfK on my portfolio, I add them to my Twitter followers or something, or I follow them on Twitter, or can they just not be bothered?
Bernhard?
No, from my perspective, not yet. Not yet. I don't get that feedback in the one-on-ones, and the investor has so many different platforms to interact, and personal and direct interact. I'm not quite sure if they're really interested to give questions on that platform. They are more, I would say, likely to see what the discussion on GfK is, what is happening on that, and then they will look at that, but not active. They take as, I would say, as an next source. What the market thinks about that. So, but I think all the professional investors have so many opportunities to talk with you that, from my present perspective, they don't need that.
Yeah, I'd just add we've certainly seen some buy side, some sell side trying to follow specific Twitter feeds or other social media pages as part of trying to get behind a company and understand things that aren't generally there. We've seen some others trying to run some quite sophisticated algorithms to actually sort of effectively sort of scan the web to find out, to pick up things. But I don't see that happening a lot. And I think the real challenge that we see for the buy side in particular is they are just inundated with information at the moment, totally so. And trying to work their way through that is obviously a challenge in terms of how the investor relations people get their story out there. But it's just it's an ongoing challenge, such that I think increasingly what you find out with PMs is the PM that answers his phone is a pretty rare beast. Yeah, almost directly always goes direct to voicemail. Many of them will never listen to the voicemails. Increasingly, I think we're seeing PMs not even answering emails. Yeah. And certainly I've spoken to a couple of buy-side firms that are effectively trying to get rid of email within the firm because it's just becoming a disaster in terms of the PMs trying to actually work their way through the information. And one sort of illustration for that, which is more frightening if you're on the brokerage community, one of the major buy-side firms, their name has appeared up here, so one of the big boys, top 20 investors in Europe, they get 1 million pieces of sell-side research sent through to them each year. That's quite a lot, isn't it? Mainly as PDFs. Yeah? 50,000 of those they actually open. So there's 950,000 they never even look at, right? But of the 50,000 they open, they read 5,000. So there's 995,000 pieces of equity research, all of which produced by people who tend to be paid more than €2 a day, yeah? Who is just disappearing. And that's, as I say, that's more of a challenge in terms of the brokerage community, where how do you feed 50 brokers when only 3 of them are valued by the market? But it is an illustration of the deluge of information that the buy side is being presented with. And as I say, I think in that sense, Twitter is a distraction, particularly because it tends to be quite fluffy, rather than actually helping them define and discern where they should be looking.
Would you say that this, as you term it, inundation with information is part of the trend towards increasingly to increase the personal interaction with the CFO and CEO, simply to get a grip on what the core is of what makes a company tick, so that we get back to the simple basics in those interviews, talking about such easy things as business models.
Yeah, Bernhard, would you like to?
Yes and no. I first, what I really see is that, and that brings me to that point, divisional director access. Maybe that fits a little bit to your question as a practical example. We started that a couple of years before, and we made we got quite good feedback out of the market. It brings me to a position where I have to brief operational people to teach them what they can say and how the other side behaves, and I have to teach them heavily, because then they get the question, okay, in China, what is your market share, what are your revenues, and if they speak, You know, it comes back to me, and that is not much fun on that, you know, to comment on that. So, but actually, it always gives, I would say, a complete picture. I position a CEO, CFO to give the strategic position and to give the long-term perspective of the company. I say to the brokers, listen, you have to accept that not always CEO, CFO can do that job. So I position IR, the activities. And then I take the next level, the operational level, where everything comes down to earth, you know, and that brings to them a complete picture. And it's a very personal driven interaction. And that brings me back, and it becomes more and more dominant, and it makes me, I would say, I have to teach people out of Brazil, China, and Russia. I have done that. So people are traveling around and saying, listen, I have an hour. I want to see your entity in China. You know, please organize something for me. I can't fly to China for one meeting. Yeah, no way. So I have to teach them. But all of that gives a complete picture, and again, it's personal. It's personal. It's not the Facebook. It's not all the others. I think that's it. Maybe my answer is different in 2-3 years. I don't know. You know, presently, as an overload of information, yeah, and you know, everybody is, as you said, 99% is just for the basket. You know, and that is something. As they earn more than $2 or pounds or whatever, you know, that is their challenge, to find the core, why to go into and why not to go into, and that's personal.
Just add one more thing to that. Certainly, I think yes, that's one of the drivers why there's more direct interaction. I think another two things to it is that the general availability of information, there's not the advantage there that there was when not everybody had actually that information. So hence that increases the desire to actually do one-on-ones. I think the other two factors I would add is firstly, so why is one buy-side firm different from another? You know, they're all sort of doing the same thing in a sense. And their difference they believe would come from their own intellectual capability, fundamentally. Yeah, some of them may be right. I suspect you can all think of ones where you struggle to know where that intellect may actually reside within the firm. But anyway, and so they think, you know, they can ask better and different questions. So if they get a chance to have a one-on-one, they'll be able to extract and unlock some value, which the fools at the other buy-side firms won't be able to find out. I think there's an element of that. On the reverse of it, and this is another driver, I think, towards divisional director access, and a big challenge for IR teams, is it's not like one-on-ones only started last year. They've been going for many years. And CEOs and CFOs at virtually every company are clever people, mostly men, some women, but they're all clever, yeah? And so, you know, they've done 300-400 one-on-ones, 3,000-4,000 one-on-ones, and surprise, surprise, they've got very good at them. They've heard virtually every question, they're very polished, they're very professional, they're used to people listening to what they got to say anyway. So the actual intrinsic value of the one-on-ones diminishes, hence the drive towards divisional access to an extent. But I think hence the importance on companies and IR teams to think, okay, how can we, without obviously breaching fair disclosure, but how can we create more interest and more value in the CEO, CFO one-on-ones? How can we give more value back to the buy side? And I think that's about being more strategic in the way that particularly the CEO, who's naturally expected to talk about strategy, will communicate with the market and actually trying to also better understand the individual PMs that you're talking to in terms of what their interests, the way that they're actually looking at the market is. Okay, is there any other questions? No?
We're competing with a lunch, which is never a good idea.
But we knew we were going to end
still
up
have 50 minutes.
Yeah,
so
exactly.
So lunch is not yet there.
No.
So there's no good alternative.
Yeah.
You said volume is going down. Is it a function in Europe or is it in the States the same?
It's in the States the same, not quite as bad as Europe, but it is in the same. Yeah. And I think, you know, if you look at on both sides of the investment community, I think in terms of the volumes, the fear in the market at the moment is this actually a secular change? And are we in an environment where the volumes will be permanently sort of 40% of what they used to be? And you can actually make an argument that that's the case, because if you look on the sort of long-term trend of volumes, they've increased massively since 20 years ago, whatever, with the proliferation of exchanges, etc., the vast increase in electronic trading. But now they've come back down. Is that just because the market's in a particularly bad place in the cycle, or is there actually this change? And that, if it is more of a change, and certainly at the moment, you know, both buy side and sell side are having to reduce their costs because of the lack of volume. If that continues, then you know, that's a big challenge. You know, I'm based in Canary Wharf, and yeah, I'm just thinking of one big investment bank that's just across the street from us. Their building houses 10,000 people, and they got 6,000 in it. Yeah, I mean, obviously to an extent that they can go a long time by not filling it completely, but essentially the model that is built for the investment banks is built on a very active market. And if it is, as I say, a secular change and those markets are reduced, and by and large, that's a sort of Western phenomenon at the moment, not just European, then I think that's a big challenge for the investment community to come to terms with, if in 2 years' time you're still in this very sort of depressed market in terms of volumes and activity.
So you talk about the overheads, and I can add some experience from my side, because we had a brick brokerage firm which did some coverage on GfK, and then when the analysts moved, I mean, I lost the coverage. Obviously, that's in many cases happens, but then we talk with each other, and he told me, listen, Bernhard, with the trading volume, I'm not really getting back what the print costs are in house. So I mean, that brought me back to the conclusion, look at the cost structure of your broker. So if the broker has a cost structure where he really needs big volume, I can't deliver because it's a mid-sized company. So my decision out of that key learning was, look at the big ones because they have a very good market access, but look as well as a small one which have a specific area, specific countries, or specific, I would say, area where they perform well, and then do road showing with them, which maybe nobody in-house would know, you know, from the brand name. So look, if you really can give back what they invest into your business, otherwise it will be not a good story at the very end.
Maybe another question. Do you think in 2-3 years' time that the split between big caps and small caps will even go up in terms of coverage, so that we get problems on the small cap companies to get enough coverage?
Yeah, I think that's already, it's been the case. I think it's just getting worse. Essentially, certainly the way that the bigger brokers have dealt with it to date is that they would not really, in some cases, yes, they have dropped coverage of small and mid-cap stocks, but effectively what they've been doing is reducing the number of people, but increasing the number of stocks that those people cover, which adds up to the same thing in that, you know, even if you're the best analyst in the world, if you're covering 30 stocks and you were covering 15, there's no way you can cover those 30 to anything like the quality you were covering the 15 before. And I think we just continue to see that. And by and large, well, yeah. Yeah, but they'll read the good ones, yeah. But I think what you also see is the growth of independent boutique research providers. Certainly that's certainly a growing trend. And one other piece of data I hadn't put up here because it wasn't directly relevant for this audience, but the number one thing that the buy side want from the brokers is independence of research. Far and away, more important than anything else, more important corporate access, more important than direct contact, that the fact that they're getting a view which is independent. Doesn't necessarily have to be from an independent firm, but it has to be independence, as I say. But the independents getting into the market are largely looking at the sort of low-hanging fruit. Yeah, they've got some expertise with big pharma or big telcos or whatever. Then there's very few who are going for the small cap stocks because, again, the volumes just aren't there at all. The interest really isn't there in terms of the investment community to go into it. And I don't see that changing unless the market becomes overall a lot more positive, to be frank. And you know, we've talked earlier about the macro factors sort of driving the market, which they certainly are. The smaller the stock is, the more challenging for the stock to get its story heard. in that context. Okay. Well, thank you very much for your time.
Thank you from my side as well.
Yeah.
Thank you.